of you or maybe all of you have known about the derivative. So yeah, I want to talk about it again, very briefly, so you have an overview of what I'm gonna say in the next 1 hour. Here is the mapping of their own financial products. We have direct investment, so we can buy stock or bond. So if you buy stock, you're a shareholder, you are the owner of the company, you're a small owner. And you can buy bond, is a debt that the company issues, so you buy an interest rate. So that's kind of direct investment, so we put money directly into the company. So you may have indirect investment. So you don't buy stock nor share, nor bond of the company, but you buy it through another financial institution. They issue to you some certificates like ETF or like fund certificate to make you have the return of those companies. If, for example, the stock or the index increase 1%, you earn 1% as well, but you don't own the index or you don't own the company neither. But they are the one who buy that and then issue the certificate for you. So in Vietnam, it's very common to have the trust and investment fund. So you just put money in there and then you pay management fees, and that's all. And then by the end of the year, they have some review for you. And then if you get some return, you pay them some commission. And that's it. That's indirect investment. And the last one, the most interesting part for today, just for today, is derivatives. So what are derivatives? I talk about it later, but we have like a whole bunch of different instruments for derivatives, like option. Option is where you buy the right to buy or to sell a stock or the meaning of a stock or of an index. And also warrant. Warrant is the same as option, but yeah, there's a little bit difference. I talk about it later. And also we have futures, swap, and forward. So yeah, they're kind of instruments yeah, form the whole financial market. Of course, there's a lot of more complicated instruments, but they are the basics. So yeah, so let's focus on the derivative now. And so before we go to the definition and the instruments that I want to introduce today, so I want to let you know that the derivatives market in Vietnam began like 24 years ago, and they started with commodities futures. So what are commodities? So you all know that commodities are something we consume and use for everyday life, like oil, gold, silver. Gold, silver we don't use it, but yeah, it's kind of resource, like natural resource, so it's counted as commodities. And also we have soybean, wheat, corn, something that is commodities. And in Vietnam, the derivatives market started with those contract in OTC. In OTC, of course, OTC is over the counter, so there's no like market standard market to make sure that you pay or you don't pay, because at that time the market was like really in the first phase of the development. So they didn't know much about how it works, the market. So yeah, just started very simple, and then step by step they developed a really nice market right now. Of course, it's not like well rounded. It doesn't have some like very complicated products like in Western market, but still it's a very a really appealing market to invest at the moment. So this is what the definition I got from Investopedia. So you can go to Investopedia and then see, okay, what is derivative? But just keep in mind that derivative is not something created by itself. We have to have another instrument which called underlying, and then the price of the derivatives move along with or in the opposite direction with the underlying, but they have to depend on underlying. The underlying asset can be what? Can be a stock, can be an index, can be the type of commodities like soybean and everything. That is not a standalone instrument, but it depends on something. So what is something? Yeah, we will learn about that. But in this presentation, I focus more on equity, not debt, but equity. So yeah, and the role of derivatives. So originally, 100 years ago, they created derivatives for hedging. So for hedging, it means that okay, in prices, if you hold a position of something, of an instrument for, let's say, a stock, you hold Apple, and you think, okay, this is crisis, and the price of Apple is going to be down for, let's say, 6 months, but you don't want to get out of the position because you want to get rid of the chances of cost. You want to stay the position in the firm, to have the position in the firm so that you can get the dividend, so you can have the the right to vote, for example. So you don't want to get out of the position. And for some institutions, is more complicated because some they have pressure from investors. I have some friends who work in big funds around the world, and sometimes they say that okay, investors always they're willing to have position in the whole portfolio that they put money in, where they put money in. Why? Because if the fund just hold cash and then be safe, what's the reason to give money to the fund? We can do it ourselves, right? So the thing is, funds, they don't want to get out of the position as well, like us want to give it. So derivatives, so they fight. They want to find something that protect their position, and that's hedging. So what hedging? Hedging is buying something which whose return goes in the opposite direction as the position that we currently have. For example, okay, again, when we hold stock, we hold Apple stock, we want to buy, for example, put option or sell call option to protect the position. And what are put option and call option? I talk about it later, but yeah. So maybe futures as well, futures on stock, like short futures is possible as well. But it's protect the position from the movement of the market, the volatility of the market. So if the market goes up, doesn't matter. Market goes down, doesn't matter, because we hedge it. We protect our position. So we want to stay safe for the next couple of months or couple of weeks. So that's derivatives, the first role. And then some professionals, some some people who have gambling mindset in mind. So okay, so why you have to hold something to buy derivatives? Derivatives is cheap, right? So you can buy it straightforward. Yeah, just go to market and buy it without any position, and wait until the price of the underlying, but for example, goes up or goes down. Doesn't matter because we earn the return like from the position of the derivative we own. If we, for example, short futures, we want the market to to tumble, to crash, to get like return because we're in a short position. So they just buy it without any position, like underlying position, and that's the speculation. And the third one is arbitrage. Arbitrage is kind of complex. So they investors, they find that okay, we see that the derivatives are mispriced. Everything, like every instrument, the financial instruments can be priced. What is price? So it's value. Like you calculate the value, the real value of the instrument. And now they see that okay, the market is mispriced. So we have opportunity to earn risk-free money. Risk-free is risk-free. It's no risk at all when we go into the arbitrage position. What's the misprice? Let's say okay, what is futures? Futures is the price we predict for the next let's say 3 months. And in the next 3 months, what happened? The futures becomes the spot. So the price converge to the spot price. Okay, what happened if you see that okay, the spot price and the future price, there's a big difference, big discrepancy between them. And okay, that's the opportunity because there's no way that the future is priced that low at the moment, and then in kind of 2 weeks, in 2 weeks it converges to the spot price right now. It's absurd. So yeah, at that time, okay, they buy low and sell high. So they engage into a position, like two-way position, long and short. Long, for example, long futures and short spot. And because the future is mispriced, they calculate based on like spot times like 1 plus risk-free rate, exponential, something like to the 2 to the 3, depends on the time to maturity. So that's later, but for now they find that okay, we have opportunity to earn risk-free return, so why not? But in developed market, they use robot a lot. They have a deep understanding of the market, so that kind of arbitrage doesn't exist. But in Vietnam, when they introduced the futures and corporate warrants, maybe 7 years ago, there were those opportunities, and even my company, we earned some return from those arbitrage strategy. Oh, sorry. Yeah, quit the slide a little bit. Okay, we have another slide here, and then okay, we focus on Vietnam market now because I worked in Vietnam for a while. I worked in Vietnam for 5 years, and I think that some of you may continue your career as an investor or work in a securities company or fund. So it's kind of interesting to understand. Firstly, at the moment, Vietnam market, and those are milestones. So commodities futures from 2000, and then 2002 is like they introduced into the market, and then they introduced OTC options in 2007, and at that time it was also OTC. The OTC is like they came to the they went to the securities company and said, okay, we want to buy options from some of the certain stocks. Yeah, we signed a contract, between us. There's no just a contract between the investor and the securities company. 10 years later, 2017, very important milestone. They introduced VN30 futures and corporate warrants. And what are they? I'm talking about it right now. That at that time, I'm very proud of one of the pioneers of the market to issue those corporate warrants to the market, and also had rights to invest in VN30 futures. And after that, they introduced also government bonds. It's very complicated and require huge capital, but so it's not for individual investors, but therefore institutions only. So that's why I want to focus now on the VN30 futures and the corporate warrants in 2017. All right, before going to the VN30 futures, do you have any questions? Just tell me. Any questions? It's appreciated. Price of the futures is okay. Okay, futures, the definitions is in the book, so you can see the definition of futures everywhere from Google, from the book, from Investopedia, and everywhere. But let's focus on two main characteristics of the futures. First is predetermined price. So you say that okay, the price of the futures is 5. Okay, the right to execute is in the future, but we set it up right now. So it's predetermined price and predetermined moment. So the in 3 months, in 6 months, in 1 year. So those one should be set up right now as well. So for now we have two components. So the price and the maturity date. And in the future, what happened? We will execute the obligations. So why I'm saying it's obligation? Because we have to execute. It's kind of different to options. Because options, this is the name. The name is option, right? So we have option to buy or not to buy, to sell or not to sell. But futures here, because we engage into a contract, so it's a contract. And by the end of the year, by the end of the day, you have to respect the contract. Let's say, okay, I put in here an example of commodities. So yeah, just like every commodities contract in the futures market around the world, but here I just say, okay, we sell very mini contract of corn, 1 kilo. And then, okay, why they engage into futures contract? Why just go to the market, go to the supermarket and just buy corn? Because they want to have that product in the future, not now, in the future, but they want to lock in a price. They don't want, because the price is volatile, they move in like different directions, we don't know. It's like an unknown factor. So want to lock it. And okay, Mr. A will sell 1 kilo of corn to Mr. B next month. Okay, Mr. A fear that okay, I will sell low in the future. So I lock in a price for Mr. B now. The same, Mr. B thinks that okay, why do we have to buy it too high if the corn price keep going up? So we lock in a price right now. Okay, fine. They enter a forward contract. Okay, so forward contract, what's that? We talk about futures. So why is forward here? So there's a little bit difference between forward and futures. And forward is something OTC, so you don't have any market. You don't have not market, but they don't have a standard market. For example, the clearing house to ensure that the money can be transferred between the two counterparties. But you just go and index the sign the contract with your partner, and that's all. And in futures, futures is a listed market, and then they are issued by many parties, like including clearing house and also the the law from the Ministry of Finance and also the Securities Commissions. They all engage into that market. Okay, so the contract is the price. The mean is 5. The maturity date, maybe in the future. Okay, I put it. I have to update it, but yeah, in the future. Let's say February. So I put it February here to make it less confused. Let's say February. Okay, let's say February 2024. Nice, in a month. Okay, at maturity means they has to sell. The contract needs to be at $5 because it's the free determined price, and because they lock in. So if the contract price trade higher, it's like we lose because because he sell lower than the market. He sell 5, but the market is 6, so they will lose $1. $1 here is like yeah, we can say $1. I want to say opportunity cost, but it's actually the cost that he loses when he sell low than the actual market, and like the opposite. If the price traded lower, you gain $1. Okay, overall, what's the interesting part of this one? He will put in the pocket $5 no matter what. So in the financial market, it happens the same. So the financial market react to events every second. So they don't want to be that risky. Okay, this is like $5. Let's say it's $5 billion. They don't want to risk like just 1% or 0.5%. That's going to be huge. That's going to be millions of dollars. So in big financial institutions, they use derivatives a lot to mostly in Western countries, mostly to protect their position. Okay, this is futures. And okay, in Vietnam market, this is the table I created for Vietnam market. What is the pros and the cons? So in Vietnam market, we can trade VN30 futures. So they have 4 different instruments. Like I don't remember exactly, but like it's 1 month, 2 months, or 1 month, 2 months, and 3 months, 6 months, something like that. And yeah, they can trade without any restriction on the capital. So for example, you deposit like yeah, it's pretty high actually. It's pretty high. You deposit like $20 million, and then you can trade on the you can buy on contract. It's like 50%. So let's say that you want to invest into not invest. No, you want to trade VN30 futures. So you have to open like basic account in every securities company. They go into, for example, SSI. Okay, I want to have to open an account, and let's include the derivatives market trading as well. So they open another different account, which connect to the Hanoi Security Commission for trading, and then yeah, so it requires another account rather than the normal account that we always have for stock trading. And okay, once we have the account and start trading, there's a lot of benefit of trading VN30 futures. But the disadvantage, the cons, is much more important. Okay, let's talk about something simple first. Pros. T0 trading. As you may know, that Vietnam market right now is not like T0 trading. T0 trading means that you buy and then you can sell immediately. But for stock, you buy Hoa Phan, you buy VW, you have to wait 2 days until you can trade it again. You can sell it. Okay, once you buy it, you have to wait 2 days. But for futures, you don't have to wait. You trade like continuously intraday. You buy, you sell, you buy, you sell continuously without any restriction on that. The only restriction is money. As long as you have money, you put money in, you're okay. So they have 2 directions, long and short. Now Vietnam is developing the infrastructure for shorting stock, but it's still not there. So if you want to short, you want to predict that okay, the market is going to go down for the next couple of months or weeks, you can go ahead and short VN30. Is all good. There's no problem at all because you can bet on the the direction that is not preferable for everybody but for you. Because they hold up, you want the market to go up, but you can bet that the market will go down, and then you short. It's fine. Little margin required. Also, it's like 50%. Maybe one contract now worth 110 million, but you have to just deposit like 1/5 of that, maybe 1/5 or 1/4 of that value, like 25 million to have one contract. So this is like margin, initial margin. You deposit 25 million, and then you can trade something worth 110 million. That's nice, and also really high return. If you bet in the right directions, it's all good. It's all good. You earn a lot of return. In the past, our company at first traded futures, but after that, it's too risky, and then we stopped at having a straightforward position of futures. And I want to tell you why. That's the cons. Okay, is little margin required? They require margin anyway. So margin is money, and money is cost of fund. So you don't have money from the street. You have to in financial institution. You have to get it somewhere else. Nobody allowed you to have cash. Like okay, some small amount of cash is okay, but there's no cash available all the time. You have to borrow from another department, from treasury department with interest rate. So if you are required of putting into the market some first money, that's the cost, and it costs you anyway. It costs you for the first initial margin anyway. And then this is the most important part of the risk of futures contracts. So market volatility. Vietnam is frontier market. Is okay. We have the different type of market like frontier, emerging, and developed. In developed market, the market volatility is lower. Is much lower because they control the risk pretty well. And they have like big institutions to harmonize the market. But in Vietnam, yeah, even though we have also big we always say big sharks to regulate, not regulate, but to participate into the market and then to harmonize it. But it's still not. It doesn't have like big impact when the market goes down, because we fear. If you see the chart of VN30 in the past, it's like a roller coaster sometimes. I remember one moment may go down like 70 or 80 point, and that's huge. That's like 4%, and 4% is huge. If you look at the let's say Nasdaq, or Nasdaq is let's say S&P 500 of the US, or like CAC 40 of France, you may see that okay, sometimes there's like ups and downs, but doesn't like really matter if you just like invest calmly into some stock that yield good returns. That's fine. I'm not talking about like a speculative stock like GameStop or something like that, but like big blue chip stock, big blue chip stock for like 5 years you're all okay. But even though you hold something big like Vingroup is the biggest corporation in Vietnam, right? But even you hold the stock of Vingroup, you can lose like 50%. That's normal, even more, even 70%. Yeah, so the market volatility impact a lot because what? Because we use leverage margin here. You put like 20% and you play for 100%. So that's like 4 times leverage, even 5 times leverage. So if the market volatility is big, it's impacting you a lot, and it costs you a lot of money. So from here, I want to start to tell you that is not recommended to go into straightforward position, aka speculation. So please, okay, don't do speculation. Okay, you want to put little money to see what is the emotion, what is your want to boost your adrenaline level for some time. It's okay. You put some little money in there, and then you see. But in the long run, it's not recommended to speculate the derivatives. Okay, limited underlying. Okay, in Vietnam there's just 4 futures contracts, and it's based on VN30. And then I'm not talking about bonds because that's a different story. But for equity, we have only VN30, and it's not really appealing. In the future, maybe they will do more based on futures on some like index like HNX, something like that. But for now, it's only VN30, and it's like limited underlying. And that's why it's not like too interesting for everybody. If you want to gamble a little bit, okay, go ahead. But for like deep in-depth analysis, for investment, I don't think that is a good idea. Okay, so got high leverage, margin required 20 to 25%, J 100%. So high leverage, maybe high return, but high risk as well. So be careful about that. That's future contracts. Okay, I forget to. Okay, so here I'm gonna stop here for a while. I wasn't looking for SSI, so just an example. So VN30 here, VN30, and then you have all the component. This is the index, and then there's a pricing. Pricing is like futures, and the like so. And you see there's 4 contract. Here's like DH Dao Han is maturity date, and you can trade those one. Actually, you can trade those one. Okay, I'm gonna stop here. I see some questions. Sorry. Okay, we have stop selling into current system. Yeah, sure. Yes, it's definitely more attractive for high volatile market in Vietnam. Yeah, if we have short position, it's gonna be more attractive market, definitely. Yes. Oh, you know about KRX, so maybe you have done some like research as well. Nice. So T0 trading is like you can buy and sell immediately. Okay, T2.5, that's correct. No, okay, we can do short selling to brokers in the gray market. Okay, yeah, that's actually right. But when you work in the field, you will understand. But this is official talk, so I want to talk about that. Okay, thank you, Chief for the information. I'm gonna continue on the corporate warrant. So some of you may know corporate warrants are options. The only difference is there's a securities company backed. Backed means they pay you money if you're in the money. Okay, it's kind of technical, but there's a definition. The contract between buyer and security company. Okay, securities company. So two-way contract, investor, security company. Why I'm saying a buyer? Okay, the buyer is you said a buyer. And even if there's call only, okay, that may be good in the future if we are short sale because we have to cover the position that we sell. So we sell call, have to buy stock to earn the return to pay you. And we don't have short sales at the moment, so we don't have put. That's logical. And if you buy option, you have rights to buy the like asset in the predetermined price. Okay, again, predetermined price and predetermined moment. So the same as futures, we have predetermined price and predetermined moments, but you have rights. So that's the right. That's not the obligation. That's the right to buy the line asset or pay. You can get paid the difference between the price of the you buy and the price in the market at that moment. So wow, that's a lot of technical things. Yeah, the price, the premium. So maybe later I will send you the slide. But some of you may understand options and warrants as well. So if I explain all of that, is going to be a waste of time. So I want to save it for the more interesting part about practical things. But
yeah, sorry for interrupting. Yeah, actually, we do have a section in class before this one. We discussed with a student about what is option and what is future as well. So I think yes, you can skip to the next part. It's okay.
Okay, nice. Thank you, Professor. Oh, okay. Let's keep in mind that in Vietnam we use like European style, not American style. So we have to wait until the maturity to have like a side. Okay, corporate warrants. So when firstly we issue the corporate warrants, we have a lot of new things to learn because okay, this is on the book, but in practical, it's different. It's not like okay, you draw a binomial tree or you do Black-Scholes model and then you evaluate, and that's fine. There's a lot of variables to consider as well. So let's go to through this one quickly. Limited loss. Okay, that's the natural of the corporate warrants options. So if you lose the money, the little money to buy premium. That's all. No capital requirement. Okay, you invest low money there, no margin. Okay, because no margin required, you just buy premium and high return, of course, because it's high leverage. Of course, high return, high leverage, so high risk. Always go through together. And okay, the cons: lose all the money, the invested money, yeah, the premium you buy, and if it's after money, you lose all the money. And market volatility again is a very important factor because it's leverage. So you don't lose one, you lose five, and if you don't bet into the right direction, it's going to cost you a lot. And then in Vietnam, no short, no put, so you can just bet that okay, the market is going up. No, if the market is going down, you cannot touch corporate warrants at the moment. I say okay, KRX, when she has that, the KRX is going to be there in 1 year, maybe 2 years. Yeah, at that time I have to recreate the slide and let's see what happened in the market. But for now, no short, no put at all. And okay, I don't put here, but the corporate warrant price depends a lot on the market making. Okay, market making. What's that? Okay, let's go back to the price board. Okay, chứng quyền, corporate warrant. For now, we have a lot of corporate warrant here. You see the list, and this is CC's core, and then FPT is an underlying. And this is the year issuance, 2023, and this is the 17th time the CBND is like issued last year. So yeah, and you can see that the spread it depends on the company. DCPH, so Tiffany is the securities who issue the corporate warrant, and you see that there is a different company. I work for BSC in the past, and you see it's not only the price, all the factors that I mentioned, but also the spread. Is the ask and beat. This is ask the lowest ask, the lowest selling price, and the beat the highest buying price. So if the spread is too high, so let's find an example where the spread is too high. So let's see this one. So this one is I think it is mature, so they don't do market making anymore. Let's find out. If okay, this one CSPG. You see that the spread is on 15 and on 20. It's like 50 of spread. And then usually when we buy corporate warrants, we don't buy like 10 corporate warrants, but we buy a lot more. So you see that always is like 10 dom. But if it's like it's more than 10 dom or more than 20 dom, it's going to be huge, because if you buy this at 120, you can only sell it on 50, and then you have to be careful. Okay, by experience, you can see that okay, what is the security company who do the good market making for you to invest in corporate warrants. Yeah, so you can see through the price board. There's a lot of information to understand. For example, giao dịch cuối cùng, the last day of trading, so the maturity, and also there's some other parameters here. But anyway, to sum up, so in derivatives market for me right now, because I'm working in risk management, it's for hedging. So hedging is not for investing, not speculating. It's for hedging. And even though the return is high, the risk is super high. It's like either high or super high. So high risk, high return, of course, but it's too risky to put just straightforward position into derivatives. And then this is those are the nature, the characteristics of own those instruments. So yeah, you can think about it later. But for me, I want to share with you my experience. So 90% of the number of derivatives investors who realize loss. So including me. In the past, I lost some money from the derivatives market. I was young. I was like 23, 24. And then I was saying, okay, that's very interesting. We have high return, we have leverage, money in there. And then by the end of the year, I do a summary of my account and say, oh, okay, I lost more than I earned, and that's bad. Why? Because sometimes I cannot understand the volatility. The volatility can be calculated for example, there's the formula for implied volatility. You can Google that for corporate warrants. But I used to put money in futures a lot, and also my calculator as well. And to test the market and to see that okay, what happened if I do like straightforward position. And I think that okay, if you're smart, you can develop a robot and you can put the parameters there and then react based on like the movement of the market in milliseconds. So just like you react like almost immediately after the market move. That could be nice. And I haven't done that. I just like trade myself manually, go to the market, and then okay, click some do some clicking, and then I was like too late. I cannot like follow I couldn't follow the market at the moment, and I realized I lost as well. But that's okay. That's a lesson to learn. And for now, as a risk management consultant, I work with those figures like almost every day. And I still see that okay, there's a little bit of straightforward position in the book of the company, but 99%, 99.5% they do hedging, they do swap, they do something like hedging, they cover that position because they don't want to bet. Like our job is to ensure that all the market, the financial market flows is running well. Not to gamble. Of course, in front trading desk, they can do whatever they want, but the mindset in Western countries they are very safe. We're Asian, I think that we have more gamble spirit. With the mindset of gamble is like bigger than those Western country investors. But still, anyway, if you want to I'm saying gamble because for me, futures, if you do straightforward position, is gamble. You don't know the chance that the market go up tomorrow is 50%. Is 50%. We don't know. Go down 50%, go up 50%. So okay, so this is my recommendations, but I don't want you to limit yourself into just your comfort zone. You can go ahead and like try whatever you want, but derivatives market is something very dangerous. You would have to like deeply understand it before starting putting money in there. Otherwise, it's going to cost you a lot. Okay, I think that's the end of my presentation.
I think what you mean is using some investment, like using derivative market for speculation is very risky. Is that right?
For
Not,
speculation,
not
yeah,
for
yeah.
hedging purpose.
Yeah, not for
Otherwise the
hedging,
student will
for
understand.
speculation.
Yeah, for the speculation purpose, it would be quite risky. And if you are the investor in the market, you should aware of that level of the risk before making decision. Is that right? Is that what you mean?
Yeah, that's what I meant. Exactly. Thank you.
Yeah. Thank you.
Yeah.
Yeah. Now time for the Q&A session. We have 5 minutes left for the meeting. I think there are some questions from the student over there. So can you help to answer this question, Thắng?
Yeah, I went to European style from Nguyên Đặng. So yeah, so you answer that. Okay, Chí Phạm again. Is the correlate like impacted by the internal company information? Otherwise, it will be. Oh, okay. Yes. So okay, internal information. You're talking about okay. First step of the internal information if you study CFA is prohibited, but in Vietnam it may